So, yes, we can get started. So, warm welcome to all of you. I guess all of you are settled up. Okay. Yeah. There is any audio issues, tech people, please check. Warm welcome to Mr. Gupta, sir, from S Bank. Hope we are audible.
Yes, sir, you're audible.
Okay. Thank you. Thank you. So, check with our director, sir, also. Bangaru, sir, are we audible?
Yeah, you are audible. You are audible.
Okay. Thank you. Thank you. So now I think go ahead. We can get started.
So a warm good morning to all of you. I, Dr. Vijay Joshi, welcome you all on panel discussion on leadership through sustainable finance. I hereby request Sri Bangaraju sir, Director SBIL, to make welcome address. Over to you, sir.
Thank you. Good morning to all of you. Am I clearly audible now?
Yes. Yes.
Yeah. Thank you. Good morning, respected guests and the esteemed panelists, and the Professor Krishna Kumar and his team, and the Managing Director, Karnataka Bank, who will be coming digitally, and all other participants from Karnataka Bank and State Bank of India, and all other participants who are digitally logged in. Good morning to all of you once again. And I extend a warm welcome to this panel discussion on a very, very important topic. Today, almost hardly a day passes without reading about the ESG related news in the media. The concept of ESG has become more important and critical for the future sustainability of our businesses and even this planet itself. I feel that all of us are tenants in this world. We are expected to use the resources that are endowed to us judiciously and pass on this wealth to the generations to come. In our urge to develop and grow, we began exploiting the natural resources beyond a degree, which has become destructive to our sustainability efforts. Climate change, as you all know, has become a major challenge today facing the world. Human activities in all areas, be it industry, agriculture practices, urbanization, mining, whatever it may be, all are contributing to a lot of actually damage to the ecology and environment, air and water pollution, or resulting in changes to the climate and also bringing in a lot of new pandemics to this world. I believe, in a way, the concept of our development process has become a comfortable disease. ESG, as you know, stands for the environmental, social, and governance practices, basically a broad framework encompassing multiple objectives that will help us in sustaining our world for the future generations. It's quite heartening to see now the entire world community started, including the sovereigns, institutions, and even the regulators, started thinking about seriously to this major challenge and exploring the ways and means to mitigate this risk. Financial institutions, as the lenders, have a critical role to play in the efforts of the community and both the players to align their practices and policies with this framework. Sustainable finance involves taking these ESG elements into consideration while making lending decisions. When lenders implement these goals in their policies and practices, it will have a tremendous influence on the course of economy towards a more sustainable development. A recent discussion paper on climate risk and sustainable finance speaks about the responsibility of banks and financial institutions in driving these ESG initiatives through their lending practices. Against this backdrop, we at SBI, in association with Karnataka Bank, our own sibling, are delighted to organize a hybrid panel discussion on leadership through sustainable finance with eminent panelists to share their thoughts on this highly relevant topic of the current times. I'm highly thankful to the panelists, especially for sparing their valuable time and consenting to grace this panel discussion. I now extend once again a warm welcome to Sri P.R. Jaishankar, MD and CEO of IIFCL. Sir, welcome to you, sir. Madam Priya Subbaraman, Chief Regulatory Officer, NSE. Madam, hearty welcome to you. And Sri Sumit Gupta, CRO, Yes Bank. Sir, warm welcome to you, sir. I'm sure that all the participants on the audience will be immensely benefited by the deliberations of this panel discussion. But my compliments and appreciation to our Dean, Professor Krishna Kumar and his team for the efforts and coordination job that they have undertaken in organizing this panel discussion, and also by roping in these erudite panelists on this panel discussion. Once again, welcome to all the participants and the esteemed guests on this panel discussion. Thank you very much.
Thank you, sir, for making welcome address. Now I take this opportunity to introduce our panelists. So I will begin with Sri Padmanabhan Raja Jaishankar, MD, India Infrastructure Finance Company Limited. With his rich experience of around 35 years in development banking and financial domains, Mr. P.R. Jaishankar is presently serving as the Managing Director of IIFCL, and he is the Chairman of IIFC UK Limited, IIFCL Asset Management Company Limited, and IIFCL Projects Limited. Before his current position, Mr. Jaishankar has held various key positions such as Executive Director of National Housing Bank, Director and CEO of IIFCL Projects Limited, Chairman, Board of Trustees of IAMCL, and Director of the India Mortgage Guarantee Company. He has been actively engaged in assisting the government in its various committees on sectoral policies, which includes leading the initiative for the first dedicated credit enhancement company for the infrastructure sector. He is a member of the Project Finance Group of the Inter-Ministerial Steering Committee for financing of infrastructure investment under the National Infrastructure Pipeline, announced by the Government of India. He is also a member of the Managing Committee of the Indian Banking Association. He structured the first ever mortgage securitization transaction in India, along with a number of other structured financial solutions such as credit enhancement, takeout finance, and reverse mortgages. Mr. Jaishankar holds a master's degree in technology from IIT Delhi and is an MBA finance from FMS Delhi University. Welcome you, sir. Now, I take this opportunity to present Ms. Priya Subbaraman. Ms. Subbaraman is currently the Chief Regulatory Officer of the National Stock Exchange of India Limited. In a career spanning over 27 years, Ms. Subbaraman has held various leadership roles in the regulatory and compliance space. Among other roles, Ms. Subbaraman headed compliance for Kotak Securities, Goldman Sachs, and Lehman Brothers in India, and managed the legal function in Kotak Mahindra for more than 6 years. Ms. Subbaraman has also headed compliance for the institutional business of Standard Chartered Bank for Southeast Asia. Ms. Subbaraman is a director on the board of National Securities Depository Limited and was earlier a board member of Lehman Brothers Securities in India. She represents NSE on the CII Corporate Governance Council and is a member of the Advisory Council of the Center of Excellence in Teacher Education. She was part of the key initiative to train women for corporate boards. She has recently included in the World Federation of Exchanges Women Leaders list in 2021. Under her leadership, NSE has taken several steps to move forward the ESG agenda through collaboration with proxy advisory firms. She is an associate member of the Institute of Company Secretaries of India and holds a Bachelor's of Law degree from the University of Mumbai. I heartily welcome you, ma'am. Now I take this opportunity to represent Sri Sumit Gupta, Chief Risk Officer of Yes Bank.
So one small question. Can Sumit Gupta ji, can you just come on the camera, please?
So he's finding it difficult to log in, and I have reported it.
So I'm there, camera is on.
I see. Okay,
Right,
okay, please.
connected.
Okay, thank you.
As a part of the initial startup team, Mr. Gupta was instrumental in establishing the commercial banking in Yes Bank. Over the years, he has been actively involved in scaling up and consolidating the mid-market business, strengthening relationships with wholesale banking clients. Besides managing supply chain finance and agri-product management, he has played a pivotal role in establishing and scaling up of the rural businesses, microfinance, and SME businesses by enhancing systems and processes to yield in higher productivity and reduce risk. Having managed a sales and marketing role for over 6 years in various national leadership positions, he is now responsible for managing the overall risk function, enterprise risk, credit risk, market risk, operational risk, information security risk, and legal risk of the bank and the central data analytics group. Mr. Gupta focuses on assessing and managing risk based on data-backed analysis. Prior to joining Yes Bank, Sri Gupta was an associate director with Robo India, sub of Robobank, Netherlands. He has over 29 years of experience in various capacities in leading organizations like Standard Chartered Bank, CRISIL, and Maruti Suzuki India Limited. Mr. Gupta holds an MBA degree in finance from IIM Calcutta, and he is BTech Mechanical from IIT Delhi. I heartily welcome you, sir.
Thank you, sir.
Now, the moderator of the panel discussion, I present to you is Dr. Kanak Wadhwani. She is a postdoctoral research fellow since 2022. Her research area includes stress testing framework for Indian banks. Dr. Kanak has been associated with academics as a faculty for close to 12 years. Besides publishing research articles and academic content in journals, Dr. Kanak brings extensive training and consulting experience to the table. She has authored a book on family managed business recently under Himalaya Publications, and her content are regularly featured in Indian newspapers. She is recently awarded with Young Women in Management for her outstanding contribution in the field of finance for the year 2018 by Venus International Foundation, Chennai. I welcome you, ma'am.
Thank you.
And now I hand over the dais to Dr. Kanak to take over the panel discussion.
Thank you, Vijay sir. Ladies and gentlemen, from emissions to transitions, from adaptation finance to sustainability linked instruments, and from national commitments to COP27, we'll be discussing all related to everything related to ecosystem of sustainable finance. So we have a perfect blend of experts with us. I would want to start with Mr. Gupta. So my question is, in the roadmap to net zero, ultimately increasing the sustainability quotient of country, we have been witnessing that leading companies are committing on net zero attainment and targeting dates as well to us. What do you see that, how do you see these targets are attainable? And how do you see the role of banks as a stewardship responsibility in it? Sir, please.
So thank you very much, Kanak. I think starting opening question is an outstanding one to begin with itself. You know, with COP27 happening and the net zero being talked about, India committing itself to a 2070 target for a net zero, specifically as a country, and different leading companies, even in India, committing themselves to achieving net zero by different timelines for the respective operations. I think it's extremely interesting to understand or to even on a piece of paper to plan the journey as to how do we get there, even theoretically. So one thing which is going to common is, the deployment of newer technologies, availability of funding platforms, and a reasonable amount of intent or change in consumer behavior, or expectation of a nuanced appreciation of the fact that somebody is being responsible in terms of being climate responsible, environment responsible, and the likes of it. All of this is going to play a critical role for us to in our journey. So both for corporates, if it's a financially weak organization, I guess it's a good visual statement of intent, but the ability to execute that intent may be challenging, may be limited by virtue of availability of resources on its doorsteps to be able to get to the destination of a net zero for its own operations. Likewise, for the country, I think the way we have shaped up our on the diplomatic front, on the economic front, on the environment front, over the last 8-10 years, I think it's been considerable steps of strength and that gives us that much amount of financial, let's say, strength as well, to be able to negotiate the newer technologies being developed in some of the countries, which can be deployed for reducing the carbon footprint in the economy. So power sector could be one big one, which is considered to be the one of the good bad boys in the entire ecosystem. And I think we as a country, having made a commitment that by 2030 we will have 50% of our capacity from renewable energies. I think that's a significant statement of intent and execution. The way we are going about in solar and every other form of renewable energy, I think that's a significant achievement. All of this will require funding support, and that's where banks come in a very big way. Banks will not just from a execution standpoint, as in funding a normal project, but I guess banks will have to be sensitive towards making sure that the projects are that much more contributed towards the environment. And depending on a case-to-case basis, which also would need evolution or maturity of of our ecosystem, as to can this be linked, can the funding be linked to certain specific benchmarks, or the project progress in terms of contribution to the environment, or the sources of funding that the banks tap in. It could be multilaterals, it could be family offices, it could be specific individuals who could be happy to invest in, let's say, green deposits. We as Yes Bank, we have been running a program for raising green deposits, using those funds on an auditable manner only to deploy on some of these kind of climate or ESG compliant projects. So banks will play a pivotal role in actually making this transformation a reality. Without bank support, I wouldn't fathom. I mean, if we have one estimation, this that the India would need over $10 trillion of funding support if we were to achieve a 2070 target of a net zero. That doesn't come in overnight. That doesn't come in easily. So we need to tap multiple sources, whether we are talking about climate financing support coming in from the developed countries or transfer of technologies to the developing world. It could mean creating awareness and developing resources from family offices, from foundations, from a whole lot of other avenues to try and, including, by the way, policy advocacy. The fact that we need to create thought leadership and policy advocacy, maybe from regulatory enablers, to create incremental pools of funding support, liquidity support, and get going in terms of tap into these things. And one critical component, maybe we'll deliberate this, I'm sure, as we go along in the panel discussion, is going to be end-use monitoring, which needs to be transparent and objective to be able to give the confidence to the lenders as banks or as people who would have actually the principal sources of funds, that yes, the funding raised is actually being deployed in the right place, and it's auditable, verifiable, independently and objectively measurable as well.
Yes, thank you so much, sir. From Mr. Jay Shankar, I would want to know, sir, we have seen infrastructure sector occupies always a debatable concerning position concerning to sustainability. And we have seen that 30% of carbon emissions is attributed to power sector and so. So, sir, what according to you should be the as substantive aspect of this complete picture and sustainability?
Well, thank you. First of all, thanks for inviting me over. I think it's a great institute, and I'm enjoying my presence and stay here. To answer your the points which you have just mentioned, I think infrastructure sector can't be debatable because it's the engine, central engine for growth, and it is recognized that if infrastructure investments are made, your GDP and your economic growth improves, and your economic growth grows that fast. There are very many studies for all these things, but more importantly, I think it's about how we develop infrastructure in a sustainable manner. That's exactly what we are discussing about here. I think as far as demonstrative effects are concerned, we have, of course, we have the net zero commitment 2070, and we have phased that out from 2030 onwards, 2030, 2050, and 2070. And if you just go one decade ago, we never had these, none of these figures mattered, and we really didn't have any concerted strategy on how we have to, what was sustainable. So all we knew about sustainability was the viability and financial viability and technical feasibility. These were the terms more commonly used. The sustainability came subsequently, and since even in 2010, the renewable energy occupied only very insignificant proportions as far as our energy mix is concerned. The coal, the thermal projects were the major, suppliers of electricity. Now, today, while the installed capacity has increased to almost 405 gigawatts, 40% of it is renewables. That means in one decade we have come a very, very long way, considering all the challenges that we have faced in the renewable energy sector, be it intermittency, be it the adoption of standards for location of land, be it the technology, the imports, various other technology related, as well as, more importantly, the finance related aspects, because the new technologies often face a lot of suspicion. And obviously the banking sector and the financial institutions had their own suspicions in the new areas during the initial phase of this process. We always had the and not only that, I think it was the dumping.
Yes.
We had issues relating to dumping. We had issues relating to foreign exchange. So all these things also were encountered. Gradually, we saw the viability aspects as well, because the thermal power, which used to be almost 3 to 4 crores per megawatt, as opposed to 12 to 13 crores per megawatt of solar those days, or wind. So I think these all culminated into a kind of electricity cost, so which was much higher in renewable as compared to that of the thermal. And looking at a normal distribution and looking at the kind of population that we have and the per capita, we had to also balance out how we have to draw the roadmap. So from that kind of a situation, today we have 40% renewable, and renewable costs almost at par with the thermal costs, and the electricity costs also being at almost that levels. We have come a long way. We have even seen 2.35, less than 2. Maybe that may be an aberration, but it ranges between 2.3 and 2.5. That is quite a bit of journey that we have come in. So that demonstrates the demonstrative effect, I would say, that India is marching towards its goal. I'm the chairman of my IFC UK company as well, and we have got enough projects. We have seen the markets in the European segment as well as in other areas, be it the emerging sector markets in Africa or the developed markets in America. I don't see the kind of focus march towards net zero that India has adopted anywhere else as much as Indian standards. So I think we are in a definitive path. So if we have to go towards this, at least the intent is very, very clear, and I'm sure with a very, very strong ecosystem that would back this, we can go through the entire process. Yes, we need a proper planning and proper proper approach for getting the right ecosystem for taking us there.
And quite comprehensive and encouraging to know. And infrastructure being the most important sector, we should be knowing about all the progress within that. So coming to ma'am, ma'am, regulatory authorities are coming up with mandatory reporting by businesses when it comes to sustainability. And in India, we are following BRSR, Business Responsibility and Sustainability Reporting, wherein SEBI has mandated that BRSR will apply to top 1,000 listed companies. So, ma'am, how do you envisage the performance of BRSR in developing a conducive environment towards sustainable finance?
So let me just take a step back and actually talk a little about capital markets per se. Right?
Yes.
So, what is the capital markets designed to do? So, a lot of bankers. Let me just take that step away. So, capital markets is really, apart from, and we were talking just before this session started, about how capital market is a very different barometer of what the reality is. Somehow markets come to know before we do. So why, I have no idea, but that's been the reality for the longest time. And so when markets, so it is not so much, and therefore to finish my thought on that, the point about capital markets and what we can do from a capital markets perspective is really disclosure. The idea is not to, so there are obviously regulations as to how a company should behave or what should happen and what should not happen. But broadly, the capital markets is about disclosure. And therefore, the markets then either rewarding or punishing bad disclosure, good disclosures versus bad disclosures. Somebody who is going to write a lot of English but do nothing else. And then somebody who is going to go in depth and actually state what the situation is vis-a-vis their company. And somebody who actually recognizes that this is the gap and what do we need to do. So to sort of quote Mr. Jaishankar, he said there's a lot of progress which has been made in the last 10 years. Also, that has happened from a BRSR perspective as well. So there was the National Voluntary Guidelines which MCA had issued, I think, way back in 2011. After which SEBI came up with the BRR. So that's the responsibility report. And then the sustainability angle has been added. So why have they added the sustainability angle? And, and again, Mr. Jaishankar mentioned, there doesn't seem to be the same kind of urgency anywhere else in the world. So I think there are two things which are driving us. One, clearly our political leadership, which wants to take its place in the world, on the world stage. So that's one. And perhaps potentially our past as well. I mean, as Indians, our parents and grandparents used to run a very sustainable economy. It's only now that we've moved away from that. From that, I mean, all of us, I think many of us who are at least over 50 will remember taking the can to the grocery shop for oil and no plastics, right? So, but coming back, so BRSR, the reason why, one of the things why SEBI did what it did was to get some level of consistency. Because what was happening is companies that needed to report and the big companies that wanted to report were doing a great job. Also had different standards. So somebody was using GRI, somebody was using some other integrated reporting, somebody was using something else. So what BRSR actually does is to say that these are the leading indicators, these are the essential indicators. They've also given some kind of explanation to each indicator. And therefore, if you wanted to, so what you get is consistency and some kind of comparability. Because otherwise, how would you compare X with Y? So BRSR allows you to do that. It also has the flexibility of saying that in case you want to actually use a GRI or any other kind of reporting, you use it. It's fine. You don't need to move away, but make the disclosure. And what is it that you're measuring and how you're measuring. So in that sense, I think SEBI is probably the only regulator which has done that. While at IOSCO, which is the Securities Market Regulators Commission, people are still discussing. SEBI's just come up with it. So there's a lot of talk and then there is action. And so therefore, coming back to your question on how this is going to play out, I think the market will decide. The quality of the disclosure and the depth of the disclosure will actually give either a company a better valuation or punish a company for this being very peripheral. So we will wait and see. But one encouraging point is as part of the voluntary, this year it's voluntary. Many companies have already actually decided to disclose in preparation of next year.
Thank you, ma'am, for putting it very clearly that leadership through sustainable finance and India's leadership through sustainability journey. And I just want to have more information on it, that how well you see these companies are prepared to disclose and before BRSR.
So the larger companies are certainly better off because they have the ability to actually get advice as well. Globally, less so the smaller companies. To that extent, we've actually worked with a proxy advisor, and on our website, there are about 38 sub-industries where people can simply go. It's free. They just, and in fact, what I said I would do is to actually give it to SBI. Maybe you can just send it to all your companies if you like. It's just, so there is a 150-page guidance for each and every company, subsectors. You can actually look at it, and it's absolutely free. So you can actually measure it. So what that guidance does is to actually tell you that. It also gives you the other one. It tells you what SASB says on this, what does GRI say, what does IR say, so that you can get a much better perspective. And plus, obviously, BRSR. So those guides are available. I think the smaller companies, anyway, it's the top 1,000 companies, but unfortunately, just given the depth of our markets, top 1,000 doesn't necessarily, the difference between RIL and the 1,000th company is a lot, which I'm sure all bankers will appreciate in the course of lending. But fact is, some of the companies at the bottom end might require much more help. The bigger ones are very clearly, as I said, quite a few have already disclosed this year as well. So they're clearly well prepared. But there is guidance available. Hopefully, this is again going to be a journey. We're not going to, in the next year, it's not as if we are going to get everything right. I think Mr. Jaishankar again mentioned it. I think some little bit of patience from everybody might be useful.
Right. Yes, thank you, ma'am. And there is quite a good takeaway for the companies who wanting to meet these reporting norms, that you can have a ready checklist available in order of priority. So for the audience present here and those who have joined us online, you can post your questions on chat box, and the in-person present audience can ask their questions as and when required. So moving ahead, towards Panchamrit targets, my question again is to Jaishankar sir. For the benefit of audience, I would highlight here, Indian Panchamrit targets are national commitments, lists 5 nectars as India will reach a non-fossil fuel based energy capacity of 500 gigawatts by 2030. India will meet 50% of its energy requirement by renewable energy sources by 2030. India will reduce the total projected carbon emissions by 1 billion tons from now until 2030. India will reduce the carbon intensity of its economy by 45%, and India will achieve net zero by 2070. So, sir, are we on the course of these above commitments, and what are the challenges you foresee as sector experts?
Yeah, you see, I will just compare it with China, because comparing with any other country would not really, make any much of ideal comparison, I should say. Because out of 1,000 gigawatt installed capacity, they have achieved 45%, renewable installed capacities today. That was over a period of, I think, 20, 25 years. In 10 years, we have, like I said, we have reached 40%, near about 405 gigawatts. The next 10 years, we are expected to go higher, and obviously 50% seems to be a very, very achievable target. And 500 gigawatts again seems to be a little daunting at today's situation and scenario. But this was the same kind of a situation 10 years ago. We never thought we will even achieve 20, 30 gigawatts. So I think looking at it, we will do it. But the point is, the kind of ecosystem that is required, the kind of approach that is required, we need to strengthen many fundamentals from the public, private, as well as, from the, policy perspectives. I think we need to see how best, we need to put in place institutions. We need to, have instruments, the right structured instruments, the financial instruments for, reaching this or financing these kind of initiatives. At the same time, we need policy, consensus, there is always, a very definitive and very recognized, need for infrastructure financing to be very, very long term. And if we need to kind of look at the electricity cost, ultimately, I'm only looking at the power sector. Even if you could look at a port sector or maybe a airport, which also is also a part of the entire program, or maybe the social sectors where the water supply, sanitation, or for that matter, pollution control standards, all these things, pollution control equipments, I should say, all these things, constitute the framework. And more definitively, I think the finance minister in her green bond framework has listed out certain sectors very clearly. That's one thing. But more importantly, I think we need a long-term perspective and a long-term financing, facilitative framework. If that is to be seen today, what is the mechanisms available? So I think we need to relook at many of the mechanisms, particularly from the regulatory perspective. One, regulatory perspective in the sense that should be more conducive for long-term financing, because today there are a lot of the Reserve Bank of India regulates the banking sector and financial institution sector, and the bond market is regulated by SEBI. So I think we need to see how best we can have a conducive framework for a long-term financing to happen in the infrastructure domain. And at the same time, from the government point of view, we need to see how best there can be fiscal incentives and tax incentives. I think, unless you have tax incentives, today, if you're going to charge 7 rupees per unit for electricity from a renewable energy source, as compared to a 2.5 or 3 rupees from a thermal, obviously, the state governments are not going to be very, very happy adopting this. Though, of course, you need to put certain, you're pushing the governments is one way of doing things. But incentivizing the governments to do something is much more beneficial and much more successful, as track record seems. So I think we have to look at adopting very, very clear tactics to kind of see how best we can reduce the cost of electricity, ultimately reduce the usage charges if it is any other sectors. And these usage charges reductions can come by way of tax or other fiscal incentives. Now, for the institutions, financial institutions, now where is the source of funds? Because all the institutions have the same source of funds. So multilateral institution seems to be the only central reservoir for long-term sustainable funds. So if that is there, institutions like the NABARD, or for that matter, for the agriculture sector, it could be NABARD, it could be for small industry, various small industry components which could be manufactured by SMEs. That's SIDBI, Export Import Bank, NHB, many other institutions which IIFCL, PFC, REC for the power sector. So these institutions can borrow from multilaterals and channelize the funds. But there is a huge disincentive to borrow from multilaterals because there's a huge guarantee fee, 1.25%. So I think we need to look at, if India needs to really progress in this direction, we need to incentivize, we need to look at a policy perspective. At the same time, we have to see how best the overall ecosystem gets a push.
Ma'am, specific to capital market, including the bouquet of instruments we have, like green bonds, we have sovereign green bonds now coming up. So how are we placed, and what are the challenges you see in capital market side as a regulator
So let me first talk about little about our experience. Of course, the amount of assets under management which are benchmarked to an ESG index is fairly low. I mean, the numbers that we are talking about and the current numbers are very, very different. But just to, and we did a 7-year, so NSE through its subsidiary company actually has 3 indices which are benchmarked against ESG. When we did a 7-year compare, of course, one index is less than 7 years. But when we took the longest possible period of time, we ended up finding that the Nifty index actually returned, X, and the ESG index returned 100 basis over that. So therefore, if Nifty returned about 12.5, this was about 13.5, and so on. So each index actually had a different rate of return, but pretty much anywhere between 80 to 100 bips was the difference. So that gives you some level of. So the way we look at that is that, why is that gap? One is, it's not as if, and I'll talk a little about the god of our times, which is not Elon Musk, but Larry Fink. But coming back to that, so why is that? We believe that some of the companies which are in the ESG are also better governed. Because they've already, if somebody has already realized the importance of sustainability, for example, potentially the tone from the top is very different to certain other companies. That could potentially explain the 100 bips difference. But coming back to this, today is the amount of money anywhere near enough, which is being raised by the capital markets for some of this, so what we need for green bond funding, for example. SEBI is also looking at something like a blue bond funding, which is more to do with oceanography and so on and so forth. So, do we have the kind of money? I think then the answer is we are a long way off. Although in the past 3 or 4 years, the amount of money in this space may have gone up by 150%, the base was reasonably low. So the gap potentially is almost, I think, about $150 billion a year. So now, how are we going to bridge that gap is something which I think policymakers, government, etc., need to sit down together and decide. But one thing I believe, I just read a news article about the Indian government itself issuing sovereign green bonds. That then, if that does happen, then that sets a benchmark for the rate. And then there are, as we know, many companies which actually borrow sub-sovereign. So therefore, if that rate is set for what the green bonds for the Indian economy, then potentially you get, you can get a lot of funding in and around that rate. So hopefully we will get a good rate and we will keep it at that. But at the moment, I think some of our previous experience with infrastructure also has had its own challenges. Therefore, we are not necessarily seeing the kind of money that should be there. It's encouraging, but I think the gap is still significantly there.
Right. Now we would want to know from Mr. Gupta. Sir, attracting sustainable green finance in India is seen as a big challenge. And can blended finance be a possible solution to this problem?
Yes, ma'am. Everything is something is better than nothing, and I guess on that sense, blended finance is obviously better than not having the requisite funding. And you're absolutely right. The market, and as Priya ma'am was also mentioning, the market is yet to evolve and develop in the on the sustainability bond side. There are pockets which are available, but I guess this is far and few. So it has to evolve, including the investor awareness and the consciousness. Eventually, if the environment is being looked for getting better, or ESG, not just from an environment standpoint, but even social and governance aspects is going to get better, it should be touching everybody's personal life as well. End of the day, we are doing all of this not to be getting any kind of a prize or recognition, but it impacts everybody's daily life as well. So hence, blended finance is obviously a good step to begin with, at least some baby step. But we will need to have an eventual destination of where the resources are available. The resources could very well be transnational as well, not just in India. It could very well be coming in from the developed world, as I mentioned earlier, foundations or the corporates, or there are programs run by the supply chains of some of the large MNCs that they could try to instill in their supply chain that we would want to look for a net zero kind of vendor supply base and work with them to try and get there. That will also partly solve, or could partly solve, the MSMEs or the smaller guys channel, because they will not have the liquidity resources to be able to get those kind of consultants, advisors to be who can advise them to what needs to be done and actually fund that as well. So there has to be a full ecosystem which will need to come together to make it happen.
So bankers as financiers to this green journey, what are the KPIs that should be considered as per you for the maybe sustainability linked loans, and how to ensure that the expected impacts are getting achieved or not? So
KPIs is of it. I mean, to my mind, I don't think KPIs is a one standard set for everybody. Every borrower is going to be different, and they have their own unique journey. Depending on the baseline that the borrower would be at that point in time, I think it will be important for whichever the lender is, if you are lending, if you are giving loans, or if you are reaching out to capital markets, as the case be, there needs to be a baseline and then an improvement over baseline, which becomes the target setting, if I were to use that word. Most of us lenders, bankers, historically are very comfortable with defining financial covenants. Right? You have, we all define, debt to EBITDA, minimum, some of the other ratios and the likes of it. In a way, this is somewhat similar, but non-financial covenants or benchmarks that we are talking about. There could be a framework of penal or non-penal pricing linked to achievement or the lack of it of certain KPIs. It could be, if you look at open any of your annual reports of large corporates, in the first few pages, the quote unquote not so relevant part of it from a banker standpoint also has per unit power consumed, and that also has a split between DG sets or whatever source of power that we have. So that is something which is auditable, which is something which is audited information available in the annual reports. Maybe as a bank, as a lender, or as a it could be capital market again. That could be very well be a KPI that the per unit consumption of power is assumed, the DG power consumed, or let's assume 1 unit, that gets reduced to 0.5 or 0.4, something which is measurable and has a baseline effect.
right. Coming to COP27, ma'am, we would want to know from you. COP27 is getting convened now. It's in progress, and it is in between the energy crisis, climate crisis, and financial up and down which everybody in the world is facing. Countries, developed countries, are taking a U-turn from their commitments and pledges. Now, earlier, which they promised $100 billion commitment was there. Now it has increased to $150 billion. How do you see these commitments would be met, or your take on it?
See, my view is that a donation at the end of the day, if you need a commercial, there has to be a commercial reason for you to put your money. Donations work only that much. So therefore, I said I would speak about Larry Fink. So let me come back to Larry Fink, who's obviously the CEO of BlackRock, and who manages assets of about $9 trillion, which is, many economies put together. So the point is, and there's data, and of course you could question the actual numbers in terms of whether they are off by 100 billion here and there, but there is data which says that if you do invest about $1.8 trillion today in terms of adaptive technologies and trying to go to the next step, the advantage or the benefit that will accrue to you, and it's not a long gestation, it's a reasonably short gestation, is about 7 trillion. So if there is indeed a case to be made for commercial benefit, then I think the money will come sooner, and therefore the money would have to come from the investors. Countries have their own, political, economic, whatever reason to do or not do something, and those things change. We saw a lot of commitments, and then suddenly from Ukraine, Russia, and then everybody wants to go back to Iran pipeline and X pipeline and Y pipeline. So I think we are very clear that sometimes the political reality might trump what you might otherwise want to do, as a country. But if there's a commercial argument to everything that we need to do, that will necessarily succeed because there is money to be made. It's as simple as that. Yes. So I think what Larry Fink has actually said, and the numbers that I'm quoting is from another climate initiative, but the whole point about Larry Fink and then Vanguard again manages about $8 trillion. Between the two of just these two companies, they are probably bigger than 100 countries put together. Their commitment as investors, I think, will be what will move the needle. Yes, I mean, if the governments want to do various things, that's great. But each of these companies have actually increased the size of their stewardship. They have very senior people heading their stewardship businesses or stewardship departments, and they have almost doubled and tripled the size. That, I think, will, to my mind, will make a far bigger impact on what needs to be done in terms of, whether US has walked back on something or somebody else has done something else. The investors and the money managers, I think, have a very large part to play.
So your views on this?
Yeah, I agree with that. In the sense, investors' interest matters most, and at the same time, I feel you have to look at a more clear vision, and the clarity should be from the point of view of a framework for the end users and for the finances. Today, when we look at green bonds, definitely yes, it's going to create a great goodwill. I think whether it's going to be translated in terms of returns, we really don't know. We hope that we get into a more a benchmark structure for this green bonds by way of this commitment. But more importantly, I think be it green or blue, I think we are color blurred today. We are not really getting into any a very, very clear vision as to what the green bond offers, what the blue bond offers, what is the framework behind it, and which are the projects. And again, projects are not just projects. Projects constitutes EPCs, project constitutes subcontractors, project constitutes labor, raw materials. It's a whole, other, ecosystem which backs that. So I think, we need to have clarity on many of these factors which actually get into the system. And from the point of view of the regulations, yes, disclosures are there, and we have a guideline kind of a thing. But more importantly, I think there needs to be a framework for, issuers, what the green bonds offers, and not just a guideline or a regulation. It has to be verifiable. First, it has to be measurable, then it has to be verifiable. And we have accrediting agencies, today in different sectors. We need to use that framework to kind of ensure that they also get into the ecosystem and verify the uses. So I think these elements in the process will have to kind of get connected, and a holistic view and a holistic vision has to be clearly implemented. I think that is more important insofar as the approach is concerned.
We want to know from Mr. Gupta, sir, COP27 comes with an expectation of deliberating on adaptation finance. And our Union Environment, Forest and Climate Change Minister, Mr. Bhupendra Yadav, has recently said, India will stress action in climate finance technology, transfer, and climate financing in COP27. So what, according to you, will this financing mechanism work?
So, well, all of us wish it will work, right? So, but I guess it's also a question of geopolitics. It's a much deeper engagements happening there. So, whatever steps, even if we take few steps in this right direction, I think we will definitely get there. So, transfer adaptation technology, it's easy to create a new ship. To change the engine of a running ship is that much more difficult and challenging. So adaptation is actually a fairly onerous task in terms of newer technologies, while you don't want to rock the boat, whatever is happening right now, so it will take a significant amount of partnership from the whichever parts of the world depend the relevant technologies are developed. There's going to be intent, political intent by the respective countries, and of course the financial support coming in extended from them. So the developed world, possibly will need to step up their contribution in terms of creating a little balm to the environmental challenges. That's just one part of it. From the maybe an E part of it, as far as you are concerned, the S and the G possibly does not need so much of adaptation funding support that we are looking at. A lot of it is going to be data led, and it could very well be our own homegrown, the revolution of which is currently underway for the last couple of years of the tech companies, of data proliferation which is happening. Whole lot of that will should contribute, to my mind, towards a far better financial inclusion, far better access to finance to a lot of people, and that itself will make a meaningful contribution to social as well as governance standards.
Right. So, as perfectly highlighted by Sir, it is either we'll all win or we'll all fail together. Sustainability game demands sustainable participants also.
Correct.
So, moving ahead, I would want to know from Sir that when we map it against the roadmap to be achieved as per UN report, the prospects look bleak. Be it coal being out by 2030 when it comes to energy generation, greener steel, cement, or mobility options like EVs and clearer agricultural undertakings, or gap to emission targets. How are we going to address this hole in climate goal? And what accelerated role do you see in this complete realm?
It's a wonderful, point that you have put in. I think that's the, this is the discussion, be it in the government, be it anywhere else. I think, let me just give an example of, ESG. IIFCL, in 2008, we have put in place a division. No financial institution or bank ever thought of that at that time. There was no need for that also, because there was not this kind of a situation was not there, and there was no urgency for doing anything like that. But we had this line from World Bank, and we had to ensure that we get cheaper funds, long-term funds, 25-year funds. So I think that forced us to ensure that we have a division. Now we are a long way. We have about 14 years experience in ESG. Managing Germany, managing France, managing US, be it the new agencies like EIB or AIB or KFW. Of course, we have JICA and all, and these are the funds which actually used to support, and they used to be conditional. So we have raised over 30,000 crores so far from sustainable finance so far. In the process, environment is a function of we, out of experience I'm telling, because now we are having a very full-fledged division which is actually into that. Environment is a function of the concessioning authorities in India, because the concessions, we are more focused on public-private partnership projects. 3,000 projects already in the national infrastructure pipeline. We already either completed or in ongoing, and another 7,000 infrastructure projects going in different non-public private areas, either on an EPC basis with central government funds or state government funds. Now the point is, if these projects needs financing, there was only one multilateral source which used to be most suited for that. Obviously LIC funds, the funds from the equity support of different institutions, all those things mattered, but the long-term 25-year funds came only from here, and we were channelizing that. Other institutions also channelize, HUDCO, PFC, REC, IRIDA, all these funds, financing institutions. But more importantly, I think environment was a function of concessioning authorities, and what concessioning authorities felt was as per the nationally laid out standards, be it in the municipal corporation level or be it at the development authorities level at the state, because it's a level of government which matters. And the developers function according to the approvals and the plans and the kind of frameworks set by our governing standards. And if you really want to adopt international standards, I'm just giving a small example of concession. Now, environment, if you have a dam or if you have an irrigation project, you need to kind of dislocate people. And what normally happens is you are given another land and you relocate them there, and with all that is how the national standards work. But if you take a USAID fund or you take the case of World Bank, they say that it's not only that, you have to pay $30 per day as sustenance for these guys. So do we have those kind of, provisions in our system? We don't have. We never had. Probably, I don't know in the future what's going to happen. But whether it's sustainable for our own fiscal situation, that's another problem. So you see, we convinced ADB, we convinced JICA, we convinced KFW, we convinced EIB, all the others. But World Bank, we were not able to convince. We gave back the funds. $2 billion I returned, saying that you come to our national standards level, or I think we have to renegotiate. The thing is, how we have to see how best we can work according to our national level requirements within our nationally laid framework, rather than getting pushed by the agenda of various institutions. That's one at one level, that political and diplomatic level, that happens. But more importantly, I think the funding part of it, you have to look at these finer aspects. Social aspects also are more important, like this. One is relocation. Concession agreements. In the concession agreements, the terms of the concession agreements, there are more than, I think, 900 to 1,000, finer points in the concession agreements, which we have accepted locally, be it a hydropower project or be it a thermal power project or be it renewable projects or be it nuclear or ports, airports, urban infrastructure, take any sector. You have different standards for all these. But then, what happens at the multilateral level is they try to standardize and they try to make a common denominator for all this, which may not really suit national requirements. So there we have a lot of disagreements on that. Not that it is a disagreement of for the sake of a disagreement. It is basically keeping our requirements, because we have 10,000 projects ongoing and we have about 400 developers which are doing different large nationally important projects in the country for different reasons, and all the projects are contributing to our GDP. But if we disrupt, because these kind of measures could lead to disruptions, and these disruptions could cause, it could, it's not just cost increase, but it could cause a lot of other economic challenges. One is cost, obviously cost, and cost has to be, borne somewhere. And for that, IIFCL had made a separate fund, an incentive, 50 basis point incentives for all the developers who actually come into that fold of, but we didn't have any except for the renewable energy players, other players in the airport, or for that matter, ports or any other housing. They never, felt that these incentives were good enough. So it's a matter of how we define these incentives on one side, on how we develop the framework on one side. At the same time, we have technologies. Now you are looking at hydrogen. We have brown hydrogen, we have green hydrogen, we have, blue hydrogen. So now the point is, brown hydrogen is not really, pushed. But we are looking at blue and we are looking at green. But hydrolyzers they come at a huge, they are costly, and as long as it's a solar powered hydrogen, it also gets recognition from the international markets. So how best we take those aspects into the technology transition. If we look at technology transition, it is very, very volatile today. What technology works today may not really work tomorrow. We're talking about, how optical fibers are going to pave way for satellite communications. I think these are all very, very important areas of, consideration, which needs a more, I think, I would not say futuristic. We probably require some clairvoyant view also today. I think we need to look at, we have to even sometimes use our intuitions for deciding what technologies, would really get into, we have to get into. So I think a lot of things are there. The ecosystem has to be in place. Today, as the situation stands, green bonds, blue bonds, whatever it is, they are all goodwill based. We can definitely get into it. We hope a benchmark will be formed. We definitely look at a framework, a legal framework, a regulatory framework, which can recognize this into a better, for pricing and for better use in our system. And that will probably pave way for, a greater adaptation.
Right. I'm sure audience must be having questions
Absolutely.
to ask.
Please,
Right.
please.
So please switch on the mic and you can ask there.
Yeah, good afternoon, sir. Just on the sustainable finance portfolios by the bank, just I wanted to bring to your notice that in the COP26 that was raised in Glasgow, it is not just a carbon dioxide gas that was going to be the problem, it's also the methane. Methane that is going to be survived. Carbon dioxide, once it stays in the atmosphere, it stays for 100 years minimum. But the methane has got another characteristic. Once in 12 years, it starts breaking into carbon dioxide. So you know that we are the number 2 paddy developers in India, in the world, and methane is contributed by this paddy growing. Being an agriculture background, GDP having an agriculture background, this becomes another way of where the bank's sustainable portfolio is getting challenged. Now, coming to the measurable point on that front, you say that power per unit production, power consumed in a supplier chain management, where in an agriculture backed economy, the measurable unit itself becomes a challenge in the sustainable portfolio, because one is emission of carbon, another is emission of methane, or any other challenges. Once produced will be input for somebody else, and the measurable therefore becomes a global challenge for all the banks. I think a more direction in this regard from your side would be, from your this thing would be helpful for the bankers, sir.
You want me to answer that?
Yes.
What you have said is all facts. That's what I just mentioned, that brown hydrogen, green hydrogen, and blue hydrogen. I was just talking about that. Brown is what? Brown is basically petroleum based and methane based. Okay. So these don't really these don't fall into the parameters for sustainable financing as well as sustainable technologies. So basically, you see, this is while petroleum based products, we are still accepting the kind of international standards as well as the arguments in favor of, not adopting that. We have some differences in methane. I agree with you. We have differences in methane. We have not yet formalized those differences still. So that is why that is hanging in balance. I would put it that way. But as far as the international standards are concerned, it doesn't really figure into that. That falls still in the brown side. So it really will not figure in the overall scheme of things for us. But yes, solar powered and water powered, those technologies still can get more recognition, as well as their adaptation could be more suitable to for the international standards perspective. So I think I may not be getting into the details of methane based, because it could be agriculture, it could be hydrogen, it could be so many other uses also. But methane as an agent for producing the fuel is not there is a difference. The Indian perspective has not completely agreed with the kind of perspective. That is still a gray area.
Please.
I don't know if that answered your questions.
That the question, once you clarified that, the question on measurable for the banks in risk management perspective.
No, it is measurable. It is possible to measure it.
And we should go.
It is possible to measure it. It is possible to do everything. But whether you will get the benefit out of it is the question. So for that, you have the green. The same thing can be done with a solar powered. See, that is the example, that always gets given. And that's a green technology. Or it could be water powered. That is, another way of looking at things. These are the, substitutes being given for that. But I don't know how best we can, answer that today.
Yeah, agriculture finance will keep it out of the purview of the study then.
Or maybe I would request Mr. Gupta if you could come in on this question, please.
Yes, I will.
Incidentally, the question is from the CRO also, so perhaps he has a perspective on it. Yeah.
So I was actually thinking about exactly the question that you asked. I said, one is there a way for us to try and target achieving perfection in terms of measuring all the variables? Or are all the variables even known? So to my mind, I think it's a journey. I don't think we have an exact fix at any point in time. And when we're starting the journey, the way I would want to look at it, whatever is something that we can measure, at least let's start with that. And as we move forward, we can of course keep on adding more parameters which gets verifiable and measurable, and the impact gets a little bit more measured. I mean, you look at the way, let's say, eastern line, let's say Odisha side, coastal areas, where the propensity or the likeliness of flooding or typhoons or some of those things is higher, let's say, than interiors of some of the other states. Now, if you were to lend to those individuals, the microfinance amount lent to those individuals in those geographies, if you were to start looking at those guys and the probability that how many days in a year possibly the person will have to leave his livelihood in that area because he will have to fend for his life and his belongingness, then I guess life things become very different. Now, is there a way for you to actually price that in or identify the risk and actually take that risk into account for your decisioning? Possibly, theoretically, the more data you have as we go forward, some of these things might just be possible. But agriculture could be a different cup of tea.
And so from banks' perspective, as we can see, international banks and financial institutions are coming up with categorizations of companies and organizations on the basis of their sustainability quotient. Maybe a traffic light kind of a segregation, dark green, light green, amber. So are we having such a mechanism or anything in such sort in place?
So it's honestly, it's evolution. I don't think we are there yet as a banking system or as a society. I think we have quite some time away. We have some of the SEBI or capital market regulator has indeed also tried to get into this space. A lot of this is going to be relevant only for the larger end of the corporates and not so much on the smaller end of the corporates or mid-size, because they will not have the wherewithal to even the cost of compliance only will make them will kill them or make them uncompetitive, and hence will become a deeper issue. So we are getting there. As a bank, we have a sustainability council. We have sustainability parameter defined as part of risk appetite also, and we measure that every quarter. And we lend some, and we don't lend to some projects which do not add up to our environmental sustainability guidelines of the approved by the bank as a bank's policy. So every bank, every lender will have their own ways. And are we looking at these kind of things for all projects? Possibly no. We're looking at trying to making sure all the larger projects are compliant with these kind of guidelines that we have. Not every single 1 crore, 5 crore, small projects as well. So it's frankly, we are definitely getting there. And as more and more banks and the regulator evolves, I guess we should be able to make a little bit of a uniformity on kind of scorecards and the banding, Today you have personal scores are available from Civil, from Experian, from iMark, all these guys. Maybe there could be a day, a few months from now, few quarters from now, maybe a few years from now, where for each company, based on data points available in the ecosystem, you could be able to create a green score, a scorecard based on the ESG.
Right. Are there any other questions from the audience?
Madam, from my side, Madam was saying on BRSR, that is Business Responsibility and Sustainability Report, and Sir said on net zero. And BRSR very exhaustive 35-page format is there. Just on that, on the environment, there are all pluses are there. What all things I am contributing to the environment, carbon emission and all. That what is the formula to ensure that to achieve that net zero? Pluses are there. What are the minuses are there? Means wherever for the banks, any lending to certain things, any points to be deducted so that to achieve net zero, any formula is there as of now?
So BRSR doesn't actually cover, your negative marking for banks. So I don't know whether, so therefore and therefore I don't have an answer for you for, what you should or should not do from a net zero perspective. BRSR, all it is doing is to try and understand where you are. It is more a status quo. It sort of determines where you are as a particular entity. So to just go back a little bit, we actually did a study of various companies. At that point of time, we had ignored banks and IT companies on the premise that, you're not directly contributing to the environment. I mean, obviously, if you run servers which are, require petabytes of data, you probably are. But and SBI probably is because you have petabytes of data. But be that as it may. What we ended up finding is that the difference between one company, the bottommost company in a particular sector and the topmost company, in auto, for example, was very small. The gold cup and the bronze cup were small. It was large in coal-based. So it seems to me that certain practices, I think it was alluded to earlier as well, in certain industries, the difference between the good and the bad is substantial. So there is a lot of gap which one can, if you're a bronze cup holder, you can go to the gold cup holder and you can take several steps. In some, it is very, very narrow. Therefore, potentially auto. I mean, everybody seems to be talking of EV and doing this and doing that. So I heard recently an example which I found quite interesting, where, for example, to get to a speed of 0 to X, before you required hardware, right? You required a faster car, faster whatever it is. Today you require software. The engine remains the same. Everything remains the same. The chip changes. So there will be technology changes which will help. So in terms, your original question in terms of are there any negative markings? Are there any anything to sort of tell you which industry you should do or which company? The point which I was really trying to get to is that it is not so much an industry as much as a company specific thing. There are lots of steps such company can take. And you as a lender probably need to look at some of those as to who is the best in that particular sector and who's not. And therefore, if you are lending to that particular person, what is it that, what is the negative that you get out of that lending potentially? But BRSR doesn't cover this.
Right. So coming to the conclusion of the panel discussion, so I would want to know, for the benefit of audience, if you can highlight 3 danger bulb on, if you say, that aspects to be addressed on immediate priority.
3 danger bulbs.
Yes, sir.
Environment, yes. Disasters, I would say. The national disasters, infrastructure can sometimes, be disrupted greatly, and the entire economy could get affected. We saw that in the floods, flash floods. Even our own country, we have seen Kedarnath and all that. I think there we need to look at sustainable and resilient infrastructure. I think we are adding this word resilient also in that, because resilient infrastructure comes at a very less initial cost, but it's over the life of the project, so it adds more benefit than the costs. So I think the resilient infrastructure in addition to sustainability. because of the disasters. I think that is a danger bulb which we should also factor in. Second is the transition in technologies. I think transition in technologies is also, some technologies we really are not really, we don't know what it would hold for. So in such cases, I think it would be more a gray area than anything else. And still, as bankers and as financial institutions, we still would be, it would be better that we actually watch and wait and watch and go with, rather than go forward without any, proper evaluation. I think that is very, very important, and it could be a danger bulb to our viability, project viability. Third one I would see as long-term financing. So long-term financial solution should come as a natural course for banks and financial institutions today, because we are now looking at technologies, we are looking at markets, and we are looking at new areas of development, because aspirations of the people is too high today. So it was not like how it used to be 10 years or 20 years earlier, where we didn't even have a mobile phone. So everybody wants the standard of living, and that is what is driving governments. So I think this is all the more, we need to be more careful about, the way in which projects are financed. And for that, we need definitely long-term financing, and regulations must become more conducive for that. I think that's not so in India. Restructured assets are still, our restructuring of standard assets is not still allowed. Whereas world over, we are having that. I sit in the board of IIFC UK, the same project where UK finances and India finances. India can't do the restructuring, UK does it as a part of its business. So I think these are things which we should align more. These are all easily alignable with the international markets. So that will get us more, more to understand the international markets and do our business in a way which is more, suitable for us. At the same time, these sustainable financing also could get a large part of the problem could get addressed by this, alignment.
Okay. Ma'am, we would want to know from you, can you highlight 3 overarching interventions from regulatory angle which can support sustainable finance?
One is, I think RBI has already joined the network for greening finance and so on and so forth. So clearly there's hopefully a pathway to actually make green finance more mainstream. Nobody is going to lend at 2.5%. Almost everybody has their own stakeholders. So therefore, when we think about mainstreaming the finance, so one is the concession, which we spoke about earlier in terms of the government support itself. But when you think about a private sector lender, nobody is going to give you that 4%, 5%, nobody's going to write away. So therefore, mainstreaming green finance and the technology part has already been spoken about. So in terms of regulatory intervention, one is obviously the whole ability to bring financing at a cost which makes sense for the financier. This is not about goodwill. You might shave off 50 bps for goodwill, but not more than that. So therefore, how do you mainstream and make money for the lender? Secondly, from a broader intervention, I think SABI has already come up with a social stock exchange, where there is and the government has actually said that a zero coupon, literally it's a donation. You don't have to return. It's some fancy name, but anyway, some security which sort of says that you neither will get the interest nor the principal. But that I think is already there. So for projects which actually are general for society's good, I think those projects need to go and raise finance in that way. The rest of the projects need to, frankly, start make money for the lender, to the extent that I think this point has already been made very, very clearly. We need long-term funding, right? At every point of time, and the political will for long-term funding. when we sit in the capital markets also, we pretty much see the same thing. Short-term funding and short-term money, which is supposed to be put long-term. I mean, half of the problems are because of that.
Market risks.
Market risk. So who's going to, I mean, we were talking just before this meeting in terms of if you are going to be stuck on one day overnight repo, and then you're funding a project, it's never going to match.
Right.
You're never going to be able to find the finance. So I think the ability for the government, I think it's probably high time to come together and provide that long-term finance made available to everybody. Our idea of long-term is 5 years. I don't think in the history of any country, long-term finance of 5 years has sustained any country. I think everybody is a banker. You all know the problems that come out of that. So SEBI, in that sense, is trying to do two, three more things. Some of this is a bit premature, but I will certainly tell you 2 or 3 things that they were doing. We are saying that bond issuers need to have less ISIN so that there's no fragmentation of liquidity. We are looking at market making, just so that there are bids and offers which are not extremely wide. We are also trying to make corporate bonds, trying to see how to scale up the whole corporate bonds portfolio, because ultimately, if you're going to be dependent only on the bank, markets by definition give you long-term money. And therefore, and that's the experience of almost every country globally. Therefore, if we can actually get corporate bonds to be a sustainable source of finance for any of these projects, I think that is where we would have succeeded possibly. So that's one intervention SEBI is looking at. We are all part of the working group. Hopefully, you'll hear something sooner rather than later.
Nice to know about social stock exchange from ma'am, for which BSE has got in principle approval recently, and this adds up to the sustainability quotient from the S part. Sir, we would want to know from you the aspects to be addressed on war footing from the bank's perspective.
So I guess, fair bit of stuff has already been covered. One thing which I would want to maybe stress upon is the increasing use of data, which is a welcome thing from a bank standpoint. I think the access to finance, whether it's an individual is concerned or it's MSME is concerned, if we can make that more and more feasible, not backed by collaterals, but backed by anticipated cash flows, which could be validated by data, I think that could be a paradigm shift in the way all of us bankers actually look at MSMEs, when you assess them for lending. A large part of the MSMEs today, lending is done in reality. We're looking at the collaterals, unless it's they're all some of the other mandated schemes by the government. A lot of it will indeed change as we get proliferation of GST data, as we have the ULIP, which is the Unified Logistics Integrated Platform of the Government of India. All of these things is going to throw up a lot of data which can be consumed by a chain of tech intermediaries, massage that, convert that into a digestible data for banks, which can give you the turnaround time of a particular vehicle, Chennai to Delhi and vice versa. And hence maybe you can price the productivity, the consumption, the loan to value ratios. Is the particular vehicle operating in which part of geography in the country? Whole lot of that is going to be backed by data. And as more and more data is available to the banks, decisioning is going to be, to my mind, I think decisioning is going to be changing for the better, and it will be far more precise than what we have been doing thus far.
Thank you, sir. With this, we come to the conclusion of panel discussion. But the good news over here is that sustainability agenda is now mainstreamed and is on the trajectory, and we as individuals can contribute a lot to it. So my profound thanks to our panelists and participants today for being here, as well as my big thanks to Director Sir and Dean Sir for entrusting me this responsibility. Thank you so much, everyone. Over to you, Dr. Joshi.
Thank you, Dr. Kanak. Indeed, I must say that the session is very enlightening, and all the panelists have expressed their views on the burning issue, that is sustainability. And I'm sure that it must benefit all the audiences online as well as offline. And I express my sincere gratitude to all the panelists for making this